Lance Roberts, and as the Chief Investment Strategist and Investment Portfolio Manager for RA Advisors, I wanted to spend a few minutes with you today to talk about my view on where we are in the markets and what the likely outcomes are going to be over the course of the next 12 months as we go through this technical shutdown of the economy. Just last week, we saw jobless claims surge 3 million. That is the largest increase in single-week jobless claims pretty much in the history of tracking this, going all the way back to 1929. That really tells you a lot about the economic damage that is yet to come within the economy. See, markets are pricing in what they expect to be the damage to the economy, but yet we have not factored in fully those specific impacts because, well, we're kind of guessing at the numbers. We haven't seen yet revisions to economic data as well as to real revisions to what earnings outlooks are going to be for companies, as a lot of guidance has been suspended. But I want to take a look at a couple of very long-term charts here to try to put some perspective as to where we are currently in this investment cycle versus where we've been previously. This first chart is a monthly chart of the S&P 500 going all the way back to the 1995 period. And as you'll see here, markets tend to trade above their long-term means for a very long period of time. That's the bull market. However, when those means are broken, typically we see a bear market ensue that typically is shorter in nature than the previous bull market, but tends to be fairly devastating to investors during that time period. The problem with the current reversion is that we've only just now broken those long-term moving averages, which suggests that yes, while we may get some fantastic rallies in the markets, they're likely going to be ultimately met with more selling as the market tends to work through a reversion in valuations and a reversion in the sentiment of the investment market. One thing you know about bear markets is bear market bottoms are not formed with optimism and people wanting to try to find the bottom and try to buy the cheap stocks. Normally, when bear market bottoms are formed, it is built on despair and a lack of optimism. People don't want to be invested in the markets because there's been too much damage to them financially. They just want to move away from the markets entirely. That's typically when you know that it's safe to enter into the water, so to speak, in terms of the environment. Another way to look at this long-term moving kind of trend of the market is in the second chart. This chart simply lays out the previous trend of the bull markets as denoted by these yellow lines. Typically, when these trends are broken, markets tend to stay below that trend for quite some time. Currently, having just broken the longest bull market trend in history, it's going to be a while before we see markets return back to old highs. So again, yes, as we said before, there's going to be lots of opportunity for markets to rebound and have these bear market rallies, but these bear market rallies are likely to be met with selling as so many investors have been trapped inside this market over the last couple of months. Now, importantly, there's some other bigger aspects here that's going on both financially as well as economically. The damage to the economy is going to be felt for quite some time. An economic slowdown of the magnitude that we're going to see from actually shutting down the economy is far different than what we see during a normal recessionary environment. And there's going to be damage to the actual consumptive ability of the U.S. economy, which makes up 70% of growth. It's what you and I buy that ultimately drive economic growth, and that economic growth is what translates into earnings for corporations and revenues, and that's what we're investing for. Currently, there's a lot of optimism that after a decade of financial stimulus from the Federal Reserve, zero interest rates, quantitative easing, that now that the Federal Reserve is coming in with zero interest rates again and more quantitative easing, that we'll have an exact duplicate of what we saw from 2009 to 2010. After just a very small reversion in the markets at this point that really hasn't done much to resolve the overvaluation issues, the belief is currently that more liquidity is going to lead to ever-rising bull markets, and ultimately we can never have a major bear market occur again. This may be a little bit misguided here, as the Fed is currently, without a doubt, trying to blow a fourth bubble in the markets to offset the bust of the third market bubble. That damage to the economy is going to be felt for quite some time. If we take a look at our composite economic indicator, which is comprised of inflation, wages, and the dollar, we see there's a very close correlation between those actions and what actually happens in the economy. Currently, that suggests that economic growth for the first quarter is going to come in somewhere around negative 2% and as much as 8% decline for the second quarter. By the fourth quarter of this year, the U.S. economy is probably going to clip in about a negative 3% growth rate overall. That's something that stocks have not priced in yet, both on the earnings side of the equation or on the investment side. Outside of this, there's also the problem with corporate leverage. Corporate leverage is now at all-time highs going into this malaise. After years of zero interest rates, companies were issuing out a tremendous amount of debt to buy back shares of stock and to really make malinvestments in terms of the economy overall. They weren't investing in CapEx or really increasing wages or helping support the lower end of the economic spectrum, but increasing executive compensation, doing buybacks of stocks, and things that actually help the corporation lever up, but not actually create more economic output overall. Combine that with the fact that over the last decade, stock buybacks have been a major support for the financial markets. That's going to go away here as companies become much more concerned about cash flows and where they're putting their investments in terms of protecting their downside risk. So the problem here is that going forward, as we look through the rest of the 2020 economy, the impact of lower economic growth is going to be complicated by the fact that debt is going to be much more difficult to service. And a lot of these companies that are carrying excess debt and leverage are going to have many more problems in terms of trying to refinance that debt as banks become much more cautious about how they lend, because again, this is a chain reaction. Each entity is now going to start trying to do what it needs to do to protect itself from the financial and economic fallout. This is going to put pressure overall on the markets ultimately and on credit markets. And reversions in the credit market, which are basically the lifeblood of the economy, are going to have a bigger impact on economic growth, hiring, and of course, the outlook for wage growth over the rest of 2020. The Fed's been creating bubbles for a long time. And this isn't a new thing. In fact, if we go back to the 1970s when the Fed became active in the markets in terms of monetary policy, there's been a repeated number of booms and busts in the markets and financial crises that have occurred because of the manipulation of interest rates and monetary policy. So what we're seeing now is something that is not new, but what we do know from the fact is that over the years of affecting monetary policy by the Federal Reserve and running up debt and creating these excess leverage bubbles in markets, we have eroded economic growth repeatedly over time. Instead of growing at 6 to 8% like we were in the 1970s, we're currently growing at 2% going into this recession, and probably coming out of this recession, we're looking at economic growth to be sub 2%, probably closer to 1%. Now, the problem with that is that's weak economic growth that barely supports population growth and certainly doesn't encourage companies to pay out higher wages and create better economic prosperity across the swath of the economy. In fact, if we take a look at the participants in the markets, this is one of the key issues here is that, yes, the Fed may create another bubble in the markets, but the third bubble in the market from 2009 to 2010 created an untenable wealth gap in the economy. In fact, currently, about 10% of the U.S. population owns about 84% of the stock market. In other words, the vast majority of the economy does not even participate in the fruits that come out of the stock market. They're simply trying to make ends meet, and they're trying to just support their families. So when they lose their jobs, when they lose their economy, it's going to be much more difficult for them to come back into the economy and to prosper at that standpoint. Of course, with slower economic growth, this means corporations are going to be much slower to hire and to bring these employees back online, and slower even yet to provide pay wages, because now there's plenty of excess labor in the markets. Excess labor supply leads to lower wage growth because employers are in control of the demand over wages versus the employee. The important point here is that this crisis is now coming at a time where we have a very different landscape than what we saw in either 2000 or in 2008. In 2000, the average baby boomer was about 45 years of age. Moving into retirement, they still had 20 years ahead of them. In 2008, 2009, they were 55 years old, still a decade ahead of them before they retired. And here we are in 2020 with a vast majority of baby boomers now at retirement. They don't have the ability to live through another crisis and come out on the other side and have time to save and grow for their retirement. There's going to be a much bigger consideration about capital preservation and preserving those assets. So when we look at our economy over the course of 2020 and really into the next decade, we've got some major challenges, from an aging demographic to a decline in savings rates. And of course, we have a heavily indebted economy, with both corporates and households heavily leveraged, more so than at just about any other point in history. And you have a decline in exports as the world becomes much more concentrated into an environment where we're importing more of our products from overseas. And of course, slowing growth rates in the economy, that leads to less ability to grow wages and to grow households across that time frame. And we've got an underemployed younger demographic, and they were just starting to come back into the workforce before this crisis happened. Now that millennial workforce is now going to be set back years in terms of getting themselves employed back into the markets and growing their income bases as well. This is going to impact the housing market, it's going to impact consumption, and it's going to impact supply and demand chains all across the country and really globally over the course of the next few years as we go through this economic recession. You know, the problem that we've had going into this was a fact that we were already moving to this service-based economy for the last 3 decades, which has continually led to slowing economic growth. The rise in debts and government deficits have continued to slow economic growth as well. And we're deterring more and more of our tax revenue just to pay for social welfare benefits as well as interest on the debt. These problems are going to get worse as we go through the course of this year and in the next year as government spending increases our national deficit to $2 to $3 trillion. Slower tax revenue growth coming in is going to expand that deficit more. And we haven't even talked about the pension fund problem, where a lot of baby boomers are now going to just start demanding to draw on their pension funds at a time when those valuations in those pension funds have been depressed because of the market crisis. This leads to a potential outcome that we're going to have slower economic growth, slower economic environment going forward, and weaker financial markets over the course of the next few years. In fact, when we look forward, we're starting to talk about rates of return on investments near zero over the next decade. Now, that doesn't mean markets will only go to zero and stay there for a decade. There's going to be some fantastic rallies that we'll want to participate in, but there's also going to be much more volatility, where over time we're going to have more frequent advances and declines. When we look back over the last decade, we'll say to ourselves, wow, we didn't make a lot of money. And that's simply going to be because the markets and the economy are having to work through this overvaluation and over-indebted issue. I don't mean to be bearish with you at all, but I do need to set expectations that as we look forward as investors, we need to be much more prudent about how we invest, where we invest, and of course, really understand the fundamental value that we're investing in. Because at the end of the day, as investors, we invest for a future return on cash flows. And when you have an impact like this, those cash flows are going to be reduced and valuations will become much more important to investors over time. And in fact, over the next decade, value will probably find its way back to being the leading way to invest over growth. I'm Lance Roberts, the Chief Investment Strategist for RIA Advisors. Coming up next, we're going to talk with Teddy Valley, the head of Per Valley Global Management. He and I are going to discuss the importance of small business as the backbone of the economy, and will the stimulus bill actually solve the problem that's needed in this economy today?